Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the day's top stories. Concord Disinvestment off the table for now as internal differences arise over the proposed move. Government to lose out on 12,000 crores in sale proceeds. It's a Business Today TV exclusive. Markets hold on to initial gains as investors wait to take cues from inflation and IIP figures. Nifty up 38 points to close above 18,600. Investors add 1 lakh crore rupees to their wealth. Udayan Mukherjee in conversation with ICICI Pru's Anand Shah. Listen in to long-term bets and find out which sectors they've been avoiding for the past few years. Retail investors ignore SEBI warnings as markets enter a bull phase. Futures and options trading zooms in May despite regulatory caution. Equity markets today snapped a two-day losing streak, kicking off the week on a good note. Headline indices staying in the green thanks to firm global cues. However, data on consumer inflation and industrial production kept investors guessing. There was also some uncertainty over the outcome of the US Fed meeting later this week. For the day, the Sensex was up 100 points and Nifty also up about 40 points, ending the session just over 18,600. The big gainers today: Bharat Petroleum, HCL Tech, Infosys, NTPC and Adani Enterprises. On the downside, Power Grid, Larsen & Toubro, Cipla, Maruti Suzuki and Titan lagged behind. While small investors keep their focus on blue chips and the movement of the index, veterans say the broader markets are giving better returns. India Today Group's global business editor Udayan Mukherjee spoke with Anand Shah, head of PMS and AIF investments at ICICI Pru, to find out which sectors are clicking and where investors can expect best profits.
Hello and welcome to this Markets Today special. I have with me today Anand Shah, who heads PMS and AIF at Prudential ICICI or ICICI Prudential Asset Management Company. Anand, very good to see you today. But let me start by asking a very simple question. How difficult has it been for a fund manager like you to beat the market over the last 1 year? I mean, the benchmarks that you follow or adhere to.
It's a pleasure to be here. Thank you for inviting me. I think last 2 years, 3 years have been actually easier than what it was before. Prior to around January 2020, we had a very narrow rally in a very specific end of the market only, and a very broader market was underperforming the index. Having said that, last 2.5, 3 years have been actually where the profitability across broader market has been much better than the blue chips, and to that extent, stock picking is actually working wonderfully over last 2.5, 3 years. So last 2.5, 3 years have been pretty much easier, and also it's actually a stock pickers market. So a lot of alpha also is something we could generate in last 2.5, 3 years.
So what are the sectors and stocks that have resulted in the alpha that you've been able to generate? I mean, relative to the market, what are the bets which have worked out for you?
Yeah, so I think if I go back a little bit into the history, what was happening was you had, as I was saying, a very narrow segments of the market doing well. And partly that was also to do with that if you were a manufacturing something, if you're a manufacturer of something, you had a very stiff competition from China. China was practically the factory for the rest of the world, and they would produce from safety pin to boilers, from tire to tiles. Whatever you need, they would manufacture it for the rest of the world. So globally, ex-China manufacturing was struggling. But in the same time, if you're a consumer of those manufactured goods, be a typical consumer or a consumer-facing businesses which were doing very well. What has changed in the last few years, and precisely more forcefully in the last 3 years, is China, which was an exporter of deflation, has become an exporter of inflation. And to that extent, a lot of manufacturing and manufacturing allied businesses, which includes corporate banks. So even within banks, if you see, a lot of corporate banks which were also at the receiving end of stress in manufacturing, stress in infra, leading to a very large NPAs and so much so provisionings for the same, have also seen reversal of fortunes. So I think our focus on manufacturing allied corporate banks, these are the areas where the earnings growth has been strong, valuations were very reasonable to start with, have helped us generate a lot of alpha.
But alpha is also generated by staying away from underperforming sectors. So which are the sectors which you have ducked over the last year or so, which has resulted in you beating the index?
Yeah, so through the last 2.5 years, we've been avoiding consumers. Last 1 year, we didn't have any IT in the portfolio. We didn't have any pharma in the portfolio. These were again, businesses were great, but they were priced for a far more growth than what actually was possible. So we sort of avoided businesses where the growth was mispriced. Our reading of the market told us that the growth that market was expecting was not possible. So those are the sectors we avoided, which also helped us generate a lot of alpha. Right. That's
No, but this is an interesting conundrum for you because some of these franchises in consumers and even IT, I would say, though more consumers, they're actually very good companies. The valuations may have been wrong. So at what point do you say there has been enough time and price correction, at least time correction, and one might look to recalibrate the portfolio somewhat? Are we anywhere close to that? Or do you see the underperformance lingering for many years?
So I think what we are looking at, look, today, the good news is that a large part of the economy will do well. This was unlike pre-2020, where a very small segment of the market was doing well. And to that extent, the challenge is now what are the sectors, what are the companies where the growth would be much better than expected, and what are the businesses where growth would be lower than what the market is expecting. In some of these businesses, especially in consumer-facing businesses, what was happening also in last decade or so, you had massive margin expansion on the back of low inflation. So your input cost was not going up. You had enough pricing power on the consumer end. So you actually had between 600 to 1200 basis points of margin expansion. What is going to happen in years to come is China, which was an exporter of deflation, will export inflation. At the same time, your consumer is still stressed. It's not. It's been a K-shaped recovery. We have been talking about it for a while. So it's not that consumer is ready to pay you for that inflation. And to that extent, what we are expecting or what we are fearing is many of these businesses have still some way to go where their margins can shrink further. And to that extent, we are waiting. Again, not that these stocks after the underperformance have become, very, very cheap. The valuation still remains steep. People's expectations are very high from them, both in terms of growth as well as return on equities. And our take is both are, challenged at this point of time. Some of them will have incremental competition also. Like paints industry, you're seeing there's so many new players entering. Similarly, in many brand businesses, there are D2C brands which are coming up. Also, there is a ownership of customer, whether it belongs to the consumer business or whether it belongs to the organized retailing. So those are the challenges which are there in those sectors. So we are evaluating them on a regular basis. We have a very large team of analysts which tracks all these sectors. But as we see today, the risk reward still remains favorable for the businesses that we've been owning for last 2 years, 3 years, which is manufacturing allied, and corporate banks.
Right. Another consumer-facing sector, though I don't think you were talking about exactly that right now, autos. Where does that stand in your portfolio?
So again, we've been underweight auto, we've been overweight auto Anks. So again, if you see, auto businesses were also beneficiary of benign inflation, and they're more consumer facing, have more distribution strength and brand power for pricing. But somebody who was an auto ancillary was at the receiving end during last decade. The other further challenge to auto companies has been fragmentation of the market. You have new players coming in, or the new segments of the market like SUVs are doing better, where you have more number of players. You have EV risk, which is around the corner, where again new set of businesses are coming in and challenging the leadership position, which had been there for a while. It was a status quo in terms of leadership in various segments of the market. So you have increased competition, a technology change which will be there. It's a matter of time, but sometime when ICE to EV is another risk. So auto is something we've been sort of underweight as far as our portfolios are concerned.
The month of May saw a spur in futures and options trading, with small investors reportedly driving volumes. This comes despite warnings by SEBI about 90% of investors losing money in the options market. My colleague Sakshi Batra spoke to market analyst Shailendra Bhatnagar about this resurgent trend and how small investors can save their money.
The market regulator has been constantly asking brokers to, constantly advise all the inexperienced retail investors on every trade that they incur on the option space as well. If you could list out the broad 3 or 4 key risks that one should be aware of before one gets in here, so that, every viewer who is interested in this space thinks twice.
Yeah, so Sakshi, first things first, if you can stay out, you should. If you are new to this market, it's best not to trade options. I say that with grave responsibility on my end, because this is not a market meant for an immature investor. Unless you've seen the market cycle for 3-4 years, you should not be trading options, point number 1. 2, you must realize, Sakshi, in the last 5 years, we've seen very heavy automation happening in the world of options. That means a lot of very high co-location servers who are running on algos, they spot the trade much earlier than a retail investor like you and me does. And by the time you get into the trade, the meat of the matter is over and you're held, you buy an option at a very high premium, which you ideally should not. The volatility that you see in options trading has been sucked out by all machines, all algos. And this comes at a time when retail participation is rising. So the reason for the loss that retail investors are making in options trading is because they are up against machines. Machines are fast, they have no emotion, and they execute a trade in 1/10 of a nanosecond.
Correct.
So you have to be very clear in your mind what needs to be done.
What would you really advise in case one still wants to go ahead and participate in this space? What is the best way to hedge your positions and be on the safer side?
On the option side, to hedge that. So it's basically a safety net. You are trying from 18-story building, the Nifty is at 80,000. So imagine you are on the top of the 18th floor and you take a leap of faith hoping that you'll reach the 19th floor. But Newton's gravity pulls you down, and that is where the option hedge is. You buy a put or you sell a call along with the long future. So at that point of time when you are falling down, the option acts as a hedge, a safety net. It protects you from making more losses. If you lose 200 points on the Nifty, your futures transaction will be 17,800 minus 18,000 into number of lots, right? But the cost of a put at that point of time could be 40 rupees, which may rise to 60 rupees. So you make a lesser loss. Ideally, in the real world, when options were launched, they were a hedge. Sadly, people have now gone into the market of just that hedge and playing that in a very serious manner. And that's a very, very dangerous thing.
Private weather forecaster SkyMed has projected a dismal monsoon outlook for the next 4 weeks. In a forecast declared earlier today, SkyMed said the inadequate rains over the agricultural heartland of India could lead to big delays in sowing and could spell trouble for the economy. My colleague Sakshi Batra spoke to GP Sharma, President SkyMed, about the impact.
The image tells a spatial distribution of rainfall during this period, that is a 4-week period. is largely month of June and also first week of July till 6th of July.
Okay.
This is the image between 9th of June to 6th of July. Okay. This is an extended forecast which is worked out based on the numerical models, giving a projection of likely weather conditions and the rainfall amounts quantitatively over different parts of the country. And as we see, it's a little alarming as far as the western, central parts, even northern parts are concerned, extending to even cover some eastern parts also. In this, rainfall are likely to be well below the norm. As it is, we know monsoon made a delayed start.
Yeah.
And after the start also, it's a little submissive, okay, very weak, where it matters most. Along the coast, it is progressed, all right, but then that's not all. Monsoon is all about reaching the interiors and giving decent and sufficient showers where they need the most, and that is where it's lagging, okay. The distribution which we are given for the month, it is a combination of both the monsoon factors also based on the cyclone which we had and also the El Nino projections which were given. Today is 12th, another 3 days, okay. But the monsoon, the pace at which it is moving a little sluggish, so we don't expect it to pick up that also. So it's going to remain a little largely slower than what it should be. So the rains obviously will be lesser than what is expected and what are desired of as well, okay. So
correct.
it's a little
Mr.
worrying.
Sharma, does it also indicate that the chances of El Nino, which you have warned us earlier, are they going to get aggravated? And if yes, then how will it affect the monsoon progress going forward?
See, El Nino always, it's not very kind, most occasions. Okay, as we have seen in the past, at least in this century, starting with 2002, 4, 9, 14, 15, even 18 also, it didn't spare us even on a single occasion. Okay, and this time is not going to be different. Okay, so we feel that, and it's a strong El Nino. It's building up. There is always a lag between the El Nino pinnacle and its peak impact on the rainfall activity and other things. There is a lag. So you can take that lag almost to about the extent of about 2 to 3 weeks. El Nino is already started, but then its impact, possibly the peak impact we are seeing now also, but I feel it may worsen in the coming days. And then we have anxious moments for various sectors, including the farming, which we are talking about. It's a crucial time, difficult time for the farmer to decide. It is a crucial month of sowing, deciding on the crop cycle also, which one to go for. So it's a very crucial decision which the farmer possibly will have to take.
Right. The big ticket disinvestment of Concord, which was expected to yield over 12,000 crore rupees, is off the table for now. The disinvestment of the public sector CCI has been derailed on account of internal differences over the proposed move. According to sources, the Railways Ministry has reservations about bringing on board a strategic investor to the company. The Union Cabinet had given its nod for the disinvestment of a 30.8% government stake in Concord to a strategic buyer way back in November 2019. The government holds a 54.8% stake in the firm. BTTV's Karishma Sudani has more on this setback. Karishma?
Absolutely right. We're picking up from our finance ministry sources that disinvestment of Container Corporation, that is Concord, has hit a roadblock. In fact, this was in the offing because the government was expected to launch the expression of interest by January, that is of 2024, but as per finance ministry sources, the government may not be able to go ahead with the process in this fiscal year of 2023-2024 because of certain issues that they are facing from the railway department in terms of bringing a new investor on board. The cabinet had given a nod for 30.8% of government stake to be sold in Concord. Government holds about close to 55% stake, and this definitely puts on a lot of plans of government's disinvestment target, which is close to 51,000 crore for this year, because Concord was contributing about close to 20 to 22% in order to fetch about 12,000 crore with its 30.8% stake.
That's where we leave it on the show tonight. Thanks so much for watching.